My gosh, we're starting early here. You guys are all early. Usually, CPAs and lawyers show up late, and then they say they were on time. And they put that on their time slip, too, by the way. My name is George McPuppet, and I am here to introduce our very mediocre and boring speaker, Alan Gassman. While he's not very talented or actually very alert this morning, he will be able to tell you a few things that you did not know, like what time he woke up and what time it is here in Florida. He'll be heading to the Ukraine to join the puppet government there. And besides, sometimes the math in these programs makes my head spin. So without really sticking my neck out, sounding like a dolphin, I will now introduce the speaker, although I'd rather not introduce him. I'll be drafting trusts and doing some research, and then we'll see you at the end of the show if you're still awake. Thank you very much. Hey, welcome to part 2 of Tools and Strategies to Avoid Estate Tax. I was hoping to cover the other half of the materials that I started the last program, and I realize that I have 400 pages in 2 pieces, 1 PowerPoint for you. So we'll see how far we can get, and then I'm sure we'll have a part 3. I will be watching for your questions in the question panel. Let me go ahead and get to the beginning of the slide deck, except I started on page 27, Tom Peters. If you're not confused, you're not paying attention. And then sometimes in the planning world, people ask, how do you come up with a good plan? Well, another great Tom Peters quote, ready, fire, aim. Just try some things out, run the numbers on them, get a 14-year-old to help you see how Excel works, and always, if you can, underpromise and over-deliver. So going back to the beginning, which is sometimes an interesting place to start, according to Mary Poppins, if you enrolled to this program through cpaacademy.org, then you will receive credit. We will be doing some polling questions. So when we get to the polling questions, if you enrolled through cpaacademy.org, you'll do your normal thing. If you enrolled through our normal website, if you enrolled through this, then you will not get CPE credit. So if you are a CPA and you want CPE credit and you enrolled through our website, go ahead and click off, escape, check out the news and your favorite YouTube video, and then come back in through CPA Academy. It'll hardly be worth it probably, but you will get the credit. So that's important. Now also, thank you all of you CPA Academy members for, wow, I've got somebody from Anchorage, Alaska. Hello, Martha, nice to see you. If you want to ask questions or give glib remarks, which is more often what we get from CPA Academy members, just go to the questions panel, click on the inverted pyramid, sing the King Tut song by Steve Martin, and born in Arizona, got a condo made of stona, King Tut, and then put in your question, and I'll be glad to pretend to answer it. For you CPAs and lawyers who are members of AIRA or would like to see what a good tax bankruptcy and restructuring conference is like, Christopher Denicolo and I, June 14th, which is my anniversary, don't tell Marcia, but I'll be really looking forward to this presentation. That's this Tuesday. And if you're in the Ohio bar, or you would like to support the Ohio bar, or you've ever been to a bar, or you'd like to go to a bar, I'll be talking about clawback on Thursday the 17th, or is that Friday? And 50 ways to leave your legacy. Okay, so let's do some content. What I have here is a lot of things from Part A, but from Part A, let's remember that we want to use a team approach to estate tax planning. The lawyer, the accountant, the investment advisors, the life insurance advisors, the certified financial planner, and the psychic and the psychoanalyst. Now, I spent a lot of time on the psychoanalyst booth this week talking to people who have cryptocurrency and real estate where the values have exploded. And I begged them to diversify. And they said no. So when you get a client whose 75% of their net worth is brand new because their beach property is now worth more than everything else they have, their cryptocurrency is now worth more than everything else they have, and you explain, you know what, if you sell today, you can maintain the XYZ standard of living for life. If you don't and it crashes, then you'll have to work an extra 10 years. That's okay. I'm confident it will not crash. So Judge Posner, who wrote a great book on capitalism in 2009 called A Failure of Capitalism by Judge Posner, does a great job of giving you the history of bubbles, beginning with the great tulip bubble in the 1600s and the many bubbles that have happened thereafter and what people do in bubbles. They are absolutely convinced that the bubble they're on could never go wrong. And guess what? Sometimes it does. And then, of course, a Peter Drucker quote, which I gave the last one, but it's important. If you want something new, you have to stop doing something old. And hopefully that is not sleep or the relationship with your significant other. There's something else you'll have to cut out. Perhaps it is Saturday webinars. Perhaps it is doing something that you can delegate in your business so that you can have time for your estate tax planning. Or maybe it's actually delegating the estate tax planning so that it does get done. So I have checklists and information, et cetera, et cetera. But one thing that's new that I want to cover in more detail is the Florida Spousal Limited Access Trust. We have a lot of Floridians on this program. I know that there's a lot of Floridians because I'm having to go a little bit slow to let everyone keep up with me. I happen to be a Floridian as well, which may explain the situation. But one thing I want to mention first is that Florida now has a 1,000 year trust statute. It's no longer 360 years. That makes a difference to some people, believe it or not. And then the new Florida statute, which says that if I form a trust for Marcia, I am the grantor, she is the spouse beneficiary, and after her death, I become a discretionary beneficiary. Then under the new Florida law, my creditors cannot reach into the trust because I am not considered under Florida law to have been a contributor. And as a result of that, because I'm not considered to have been a contributor to the trust, because my creditors can't reach in, under Internal Revenue Code section 2036A, if the trust is drafted properly and administered properly, the trust will not be considered to be owned by me for federal estate tax purposes. So before July 1st, 2022, in Florida, I could not form this trust for a spouse and have the grantor spouse become the beneficiary at any time. I could do that under certain situations in an asset protection jurisdiction like Nevada or South Dakota or Alaska, but not in a non-asset protection jurisdiction, except for one of the 10 jurisdictions that has the same law that Florida does. So it's important to note, though, that I can't just put in that trust agreement that after the death of the contributor, of the beneficiary spouse, the contributor spouse could be the trustee, or could have the right to receive what's needed for health, education, and maintenance. Because if you do that, it will be a 2036A power, most likely, if the IRS takes a look at it. So there are going to be significant number of these trusts formed, and they're going to be formed the wrong way because people don't understand them. The other issue in Florida is the exception creditor issue. And the exception creditor issue says that if I form a trust and any person is a beneficiary, and then a creditor of that beneficiary can reach into the trust. If the creditor is a professional who rendered services relating to the trust and the beneficiary has no other way of paying it, or the creditor is a spouse or a child for spousal or child support. So therefore, if I form this Florida trust for Marcia, even though I'm not a beneficiary unless she dies before me, if I go and hire a law firm and they run up $1 million bill challenging the trust, and I can't pay the bill, then the bill gets paid by the trust. Is that enough of a benefit that I'm still subject to estate tax in the trust? And we don't know the answer to that. Or that I could have a child out of wedlock, and then that child could reach into the trust and reduce my child support. Is that enough of a benefit that I could be subject to estate tax as if I was a beneficiary of that trust? We don't have an answer to that. Proponents of the Delaware Asset Protection Trust believe that that's not a problem because it would be what they call an act of independent significance for me to want to challenge my own trust, or for me to have a child that I would not pay the child support. And that's probably correct, but nobody is absolutely sure. So our recommendation, and we've published on this, I'll be glad to send you a copy of the article if you like, is that if you live in a exception creditor state and you're doing a SLAT, and that would be the only issue, then set up a separate $500,000 exception creditor trust, which says, if and when any trust I have ever established would ever be invaded by an exception creditor, pay them out of this trust. And as to any other SLAT, if and when an exception creditor could ever reach into this trust, the grantor will no longer be a beneficiary under any circumstances whatsoever. And then a Florida SLAT will probably work. So the other issue is, if I form a SLAT for Marcia's lifetime and I can't become a beneficiary unless Marcia passes away, should she give me a healthcare power of attorney where I can pull the plug? And the answer is going to vary from family to family. But if you're talking to Marcia, probably don't mention this. So I've got a lot of literature on the whole issue of 2036A, Florida, exception creditors, the doctrine of independent significance, and the first polling question. So Brittany is going to help me with this first polling question. If you are Matt Polling, the real estate lawyer in Tampa, that's not the reason for this question. If you are a CPA with CPA Academy, you'll want to answer this question. The answer to the question, by the way, is all of the above, but don't tell CPA Academy I said that. Which of the following are true about grantor trusts? The grantor trust would include a SLAT that I set up for Marcia's lifetime, never subject to estate tax on my death, yet in my estate for estate tax purposes. Number one, I can enter into transactions with that trust, and those transactions, such as a sale with the trust, will be disregarded for income tax purposes. Number 2, I can pay the income tax on behalf of that trust. That makes my estate smaller, and the trust gets larger, and that is not considered a gift by me. Number 3, there is proposed legislation in President Biden's Green Book which would negatively impact the use of grantor trusts by requiring the payment of the income tax to be considered a gift. Or number 4, the correct answer, which is all of the above. So go ahead and put in D, all of the above. D was also my grade in chemistry in high school in 11th grade. I never could understand all those charts. And okay, Brittany, can I go to back to the program? Good. I know I'm good, Brittany, but can I go back to the program? Okay, so we have all kinds of slattery examples. Slat this, slat that, slat here, slat there, a slat everywhere. Okay, now I would like to show you a new spreadsheet, and Brandon Ketron, my partner who is smart enough not to work on Saturdays, designed this spreadsheet. Oh, by the way, that's if you call staying at home with a 1-year-old and a 3-week-old not working. Okay, this was a client. This still is a client. She didn't fire us yet. And she is 70 years old, and she is about to have a liquidity event. Now, that doesn't mean that she's going to drink a bottle of champagne, but I expect she will drink a bottle of champagne because there's a business selling, and the business is selling very nicely. So her personal net worth is $12 million, and she spends $600,000 a year in taxes and living expenses. And she is pessimistic about her investment portfolio. So she is looking at a 3.2% rate of return. And she wants to make sure that she is not going to run out of assets. Let's be a little bit more pessimistic here. Let's go with a $7 million net worth. Okay. And let's say her spending is $700,000. Right. She has sold significant assets to a defective grantor trust, and she is going to have to pay the income tax on the income from that trust. And based upon these numbers, she is going to run out of assets at age 92, and she's not very happy about it. So let me show you my columns. This is her net worth. This is her money plus a promissory note owed to her. So what happens is she runs out of money at age 84, but at age 85, a promissory note owed to her by the defective grantor trust balloons. So her cash flow goes up and she runs out of money at age 92. At 3% growth, here's the growth in her assets. Here are her annual payments on the promissory note at 2% interest. This is her withdrawal for spending. This is her ending balance. This is the note payment from the Descendants Trust, which will be worth about $10 million after the transaction. Here is her taxable estate. Here is the estate tax exemption. Here's the estate tax she'll pay. And there's the net estate for her children. So this is a nice spreadsheet to have. Now, if her spending is going to go up, because after the transaction, she's going to have more expenses because the company's not going to pay for as many things and she's going to want to travel more, then she's in a more desperate situation. If we had formed the grantor trust in an asset protection jurisdiction and had made her an addable beneficiary, then she wouldn't have to worry as much, but she would still worry. And in this particular client's situation, that was still a concern. Now, if she's spending a lot of the $800,000 on income tax and she gets mostly ordinary income, and after the transaction, she's going to have more capital gains income and less income tax, then her cash flow situation may be significantly better. But another thing we can do for her is we can convert the $4.5 million promissory note into a private annuity. So instead of her receiving $80,000 a year of interest, I can click here to make that a zero and see that she could receive a private annuity for the rest of her life of $441,097. And then she would not run out of assets. In fact, at age 100, for her 100th birthday party, where I'll be 93, so I'll pick her up and take her there, she'll have a net worth of $5 million. But what we had to show her, because she was getting, concerned that she should convert part of the note to a private annuity. But, what we showed her was, let's say you don't have an estate tax issue, but what if your investments grow at 7%, which is the historical average for her investments after taxes? Well, now you're going to have an estate tax of $8 million. So she decided to go ahead and keep the promissory note where it is, because then with the 7% rate of return, she's still going to have $5 million at age 100, but no federal estate tax. So if you'd like this spreadsheet, and we're going to be improving it before you see it, the next presentation, it's going to show you the amount in the trust and the difference between toggling on and toggling off grantor trust status. But if you'd like a copy of this spreadsheet, just send me an email, put the word spreadsheet in it, and I will be glad to send it. So I think we're going to call that the equilibrium tester. And I'm going to go back and do the second polling question now. And that is going to be at page 40. For those CPAs who are still awake. Okay, here's the second polling question. Brittany, I assume you're launching it like an astronaut. Okay, which would you prefer to receive for free as a PDF? And if you answer this, we will send you what you request. A, our book, 8 Steps to a Successful Florida Estate Plan. B, Planning for Ownership and Inheritance of Pension and IRA Accounts. C, our book written with David Finkel and Parik Singh, Grow Your Medical Practice and Get Your Life Back. It's only one book, not two. And then D, our white paper on Florida slats, actually our Lineberg Information Services article on Florida slats. And thank you very much to Lineberg Information Services for letting us share the white paper and for publishing it without looking at it first. Okay, Brittany, let me know. Good. All right. So we are T-minus page 99 and going forward. And I wanted to show you the estate plan of the week. I will find here. Well, I'll find it as we go along. That checklist. All right. Here is an estate plan you have not seen before. And you have a client who is married, presently in a community property state, has a joint trust and several properties and several investments. A beautiful charitable intent. The client came to the United States at a very early age and has been very successful, worked their way through college, graduate school, a professional program, internship, fellowship, medical professional, did very well because of hard work and saving and very smart investments. So it would make sense to set up a spousal limited access trust and to have an LLC and to put the investments under the LLC and then to transfer a 99% non-voting member interest to a spousal limited access trust in exchange for a promissory note. So let's say that the investments are stock market type of investments and real estate type of investments, and they're highly appreciated, and he would like to diversify. Well, step one, I can put those assets in LLCs, and then I can have him donate 100% of the LLCs to a net income CRUT, a charitable remainder unit trust. And this charitable remainder unit trust will say that every year it will calculate its value, multiply it by 11%, and then pay its income or 11%, whichever is greater, to this LLC. So then he puts the assets into the NIMCRUT. He sells the assets, but they stay under their subsidiary LLCs. There's no income that comes through the subsidiary LLCs to the NIMCRUT, so there's no distribution to the NIMCRUT, but there's going to be a makeup. Okay, if he puts $10 million worth of assets into the NIMCRUT, and then he retains the right to receive 11% a year, but only to the extent of income from the NIMCRUT. He appoints an independent trustee who decides if and when to make distributions from these LLCs, which would trigger income. And the end result is no income tax until there's a distribution. And in year 14, the distribution will be of about 70 to 78% of the value of all the assets under the NIMCRUT. And at that time, the income tax will be payable by him or the SLAT, depending on what he decides. And then in years 15 through 20, there will be more payments out. And at the end of the day, about 10% of the whole shooting match will go to his family foundation. So he's going to get a $1 million income tax deduction. He's going to pay no income tax on the income generated from the sale of his depreciable real estate and Bitcoin and other investments, so he can diversify. And what is the NIMCRUT worth? Well, you would say, Alan, you're putting $10 million worth of assets in the NIMCRUT. 10% is actuarially measured as going to charity. So it's a $9 million NIMCRUT. So when he sells the 99% interest in this LLC in exchange for a note, assume a 1/3 discount, that would be a $6 million note. And you've changed $9 million of value to a $6 million note. Well, I called a valuation expert this week. I said, Brian, what is that unit trust interest worth? And he said, well, how liquid is it? Well, he may not get a payment for 15, 20 years. Okay, what's the tax treatment? Well, it's already got about 6 million of income inside of it that'll be taxable to the owner when it comes out. You think it's worth 9 million? No, it's not worth 9 billion. I've been told by reputable lawyers that it's worth less than half of that. So you've got something going to charity, which is nice. You've got a little bit better discounts or a lot better discounts, depending upon how that comes out. And you've got an installment sale to a defective grantor trust. So I thought that was pretty nice. Okay, we'll come back to polling question number 119. Please remember, the applicable federal rates are going up fast. In June, the long-term applicable federal rate, you see how they were going up through April? In June, it is over 3%. And I'm sure it's going to be more than that next year. So that's important because that controls how much we can charge for a long-term interest note. Going back to that, if I can find it again. If you can get your transaction done in June, then you can use the lowest of April, May, June rates. That'll get you 2.25%. If you can't get your transaction done until August, you're going to be at over 3% if you do a 9-year note. So over time, that's going to be a problem for people who waited. Okay. A call I had today, or not today, a call I had, actually an email I had Tuesday. My parents set up a really nice, large, irrevocable trust for me and my descendants. And my parents are still alive. They're in their 90s. The trust's assets are worth $5 million. My parents are worth $5 million. The trust assets only have a $1 million income tax basis. How do I avoid capital gains tax? And the answer is, let's go to court and give your parents a power over the trust to redirect where the trust assets go, because they don't need to not have that power anymore because the estate tax has changed. And let's limit that power to only apply to the extent that it would not cause estate tax in their estate. Let's have the judge implant that power to them. And then when they die, whether they exercise the power or not, the assets in that trust will get a new fair market value income tax basis. Or what if the parents are already deceased? Well, then maybe give that power to a very wise aunt or a very wise uncle. Technically, when you read Internal Revenue Code section 1014, you could put in the trust, I hereby give this power to the first person who dies in the nursing home at the corner of Elm and Maple. And then that first person who has that power, they may not know they have the power, but under state law, they have the power. I would tell them they have the power. You could make the power exercisable solely in favor of their estate. And technically, I'm not saying a court would allow this, but technically, as I read the statute, that would get you your step up in basis. So it's easy to forget to put a provision in here. Now, one lawyer contacted me a couple of weeks ago and said, I don't know if the local judge will do that. The local judge is a little bit picky, and I don't know if I can convince him to do that. Okay, well, could you convince the judge to simply provide that the trust will have trust protectors, and that the trust protectors will have the typical powers that trust protectors have? And will the judge appoint the trust protectors? And then after that, the trust protectors can go ahead and exercise their right to give an appropriate person that power. And if you're going to give an appropriate person that power and it's not the grantor, then also give them a withdrawal right and dribble some money out to them to show that there's a sincere business purpose here. Another lawyer said, if I do that and they have the right to direct assets to creditors of their estate, exercise it, and then what do you do? Well, fortunately, the Treasury regulations under section 1014 say that a power of appointment exercisable only with the approval of a non-adverse party who is not a fiduciary, is still considered to exist under for estate tax and income tax purposes. So you say, I give Uncle Peter the power to direct trust assets to creditors of his estate, but only with the permission of my favorite high school basketball coach, John Smith, and my next door neighbor, Dora Doorknob. And then your uncle dies, you're very sad, you go to the funeral, and you sell the assets and don't pay any capital gains tax. So now another lawyer said, wait a minute, if you give that person a power of appointment, will creditors be able to reach the assets? And the answer is, well, if the power of appointment is limited to only being exercisable with the approval of the next door neighbor, is it really a power of appointment? And the answer to that question varies from state to state. Under the common law, creditors might reach in to that trust. So that could be an issue and a reason not to tell anyone that the power of appointment exists, except you need to know whether uncle is going to file an estate tax return to know how much your step up is. You could put a serial step up in there. You could put 5 people, and then each of them has the power, and then the step up occurs as each of them dies. So this thing is getting fancier and fancier. Seems to me more and more likely that the IRS will notice it and ask Congress to change the law. But until then, it is out there. The 642C charitable deduction trust. So we have a client who's very charitable and wants to donate more than 50% of her adjusted gross income to charity. She'd like to give 100% of her adjusted gross income to charity. And she has a high income asset. Let's say that the high income asset is a building and it throws off $1 million a year of net rent income. So if she has $2 million a year of income, the first $1 million she can donate to charity and get a income tax deduction. That's 50%. That's up to 50% of her adjusted gross income. Okay, what if she does this? She puts the building in an irrevocable trust, and the irrevocable trust is separate from her for income tax purposes. And that irrevocable trust has $1 million of income. Now, that's a reason for her to create an irrevocable trust, appraise the building, put the building in an LLC. Let's say the building's worth $10 million. Put the building in an LLC. She keeps 1%, maybe 0.1% goes to a grandchild trust, as we've described before. She transfers 99% of the LLC to a new irrevocable trust. That trust receives $990,000 of income, and it donates $990,000 of income to charity. That trust is not a person. It is not subject to the 50% of adjusted gross income limitation. And under Internal Revenue Code section 642C, that income is carried out to the charity. The trust does not have to pay income tax on that income, and the charity does not have to pay income tax, assuming that it is not an active business. If the trust has an active business, then there is an Internal Revenue Code provision which makes the active business income tax, the unrelated business income tax, apply to a complex trust. But if it's rent income or it's dividend income, this is a great way to get this completely out of her estate. Now, what if she thinks she may need the assets later? Put it in a Nevada, Delaware, or Alaska trust. Those are the 3 states that don't have exception creditors, so I think they're a little safer than Delaware. And then allow the protectors to be able to add her as a beneficiary. She's not a beneficiary, but her good friends, the trust protectors, could add her as a beneficiary. They have no duty to do so. Now she's got a great business purpose to get a discount on that building, get $1 million of rent out of her estate in case she wants to leave other assets to other people. So that is the 642C complex trust. Okay. Want to do another polling question now. The spousal limited access trust. You remember this? It seems like only 2 hours ago. Created by one spouse for the other. The beneficiary spouse can be the trustee. The beneficiary spouse can have a power of appointment. And the correct answer, D, all of the above. Brittany, let me know when we have enough answers so that we can go to the next interesting slide. Hum a song, but I'd probably violate copyright. Okay. Thank you very much for that. Here we are, surfing away, looking at all of the different types of techniques that we've talked about and that we are talking about. I would like to mention the JEST, the Joint Exempt Step-Up Trust. I can send you articles on the JEST if you like. You can just put in the RE line of the email to me at agassman@gassmanpa.com. I'm not jesting or jest, J-E-S-T. The JEST is a way to complicate things a little bit, but to have a joint trust, which, trying to find a good picture here, a joint trust, which on the death of a spouse delivers a new income tax basis on all of the assets in the trust and allows the family to maximize the use of the first dying spouse's $12,060,000 exemption and assists with estate tax planning after the first death. So normally, what most people in non-community property states, which includes Florida, do is they have a separate revocable trust for each spouse. So if I die first, up to $12,060,000 can be held for my spouse as a credit shelter trust, never subject to estate tax on the spouse's death. But let's say that Marcia and I don't have $12 million. I'm sure that would be hard for you to believe that we wouldn't have $12 million. So let's say we have $10 million. And after, we don't know who's going to die first, so we would put $5 million in each trust. And then one of us dies, there's only $5 million locked up, and the rest of the $12,060,000 exemption is not as well used. Because if I don't use the whole $12 million when I die, Marcia gets a $7 million portability allowance, but it doesn't grow with inflation. You can't use it for generation skipping tax planning. And if she marries somebody else who's wealthier and they die first and leave it all to their children, then she gets no portability allowance. So that would be sad. So instead, we put the $10 million in assets into a JEST. And when one of us dies, 10 million locks up into the credit shelter trusts under the JEST. So we use 10 million instead of 5 million of the exemption. The whole 10 million can grow estate tax-free, benefit the surviving spouse in a more complicated way, but in a way that does work. And that also better protects the assets from the next spouse. So therefore, the surviving spouse is happier. They don't have to worry about whether they can go ahead and remarry somebody wealthy who has their own children. They have $10 million protected from that next spouse and from federal estate tax. And they get a full step up on the whole 10 million. In the first example, I die first, Marcia only gets a step up on the 5, not the whole 10. So that is the Just Trust. Now, if you're in a community property state, which notably includes Texas and California, you don't need a Just to get the full step up on the first death. But you have two problems. The first problem is if you're in California, you're paying a 13% income tax even on capital gains. You ought to get out of there anyway. But I know you don't want to because it's a great place to live and a lot of income opportunities there. The second problem with most community property states is that if one spouse gets sued, the creditor can reach all the community property. So when I represent a neurosurgeon in California, with the assistance of a California lawyer, we will often transmute out of community property treatment and put the assets in a JEST, a Just Trust, owned 99% by the non-neurosurgeon and 1% by the neurosurgeon, but giving the powers that the Just Trust provides to the first dying spouse to appoint assets to creditors of their estate with permission of a non-adverse party to get that beautiful, beautiful step up in basis. Studies have shown that surviving spouses of people with Just Trusts are happier and get better sooner from the sting of the loss of their spouse because of the unity of a single trust, the step up in basis, and important to some of them, the ability to remarry somebody really wealthy who has children that they don't have to raise. So that is the Just Trust. There's a lot of information on the Just Trust. Now, why is the estate tax a voluntary tax? And the reason the estate tax is a voluntary tax is that there is, even for the super, super wealthy, federal estate tax charitable deduction and methodology available to use the estate tax charitable deduction and the gift tax charitable deduction in ways that can dramatically benefit non-charitable beneficiaries. And by the way, if anyone out there would like to leave $300 million to a charitable foundation and appoint me as the trustee of that charitable foundation, I will be glad to be the trustee of that charitable foundation, and I would not charge anything to do that, and I'm absolutely serious. But it would be nice, if you don't mind, if my law firm could represent that charitable foundation. And it would be nice, if you don't mind, if my children, nephews, and nieces could work for that charitable organization. So not to set a bad example, but if it was my family, that might be the attitude that I would have. So we talked about the NIMCRUT earlier. Here is another distribution talking about the CRUTs, and go to 119. We're going to do the last polling question. We've successfully survived a significant technical malfunction. I feel like Apollo 13, but I have plenty to eat. Okay. A CLAT can be, oh, this is perfect, a charitable lead annuity trust. I give my assets to myself as trustee of a charitable lead annuity trust. The charitable lead annuity trust says that I will give 11% or I will give a certain percent of the trust assets every year to my favorite charity, which would be the Alan Gassman Charitable Foundation. And whatever is left in the CLAT at the end of a series of years will go to my children. They're very deserving, by the way. Or will go to my spouse for life and then my children, if at the time they are deserving. So this CLAT, if I do it during my lifetime, the whole amount that I put in the CLAT can provide me with a charitable income tax deduction. Secondly, I can do this while I'm alive and watch it happen and then control the charity that receives the annual payments, or I can do it on death. That would be B. C, I could fund it with an LLC. So while if I put $1.5 million into an LLC, and then I transfer the 99% non-voting member interest in the LLC to the CLAT on my death, then I can base the annual payments to the charity perhaps upon 66% of the value of the assets in the LLC, so there might be a lot more for my spouse and descendants after my death. And then D, the correct answer, all of the above. So, Brittany, am I good to go to next, or I'm good? Brittany rarely tells me I'm good, except when I ask her if I can go to the next slide. So, that was the CLAT, and I'm sorry that I forgot where I am at. I covered it. Another great charitable opportunity that your clients have and probably don't know about is the use of a 4946A1G trust. Now, I know you're probably saying, Alan, I already know all about 4946A1G trusts. You don't have to tell me anything else about them, but I want to. When I set up a private foundation or a private operating foundation, which by definition is usually a charitable 501c3 entity where the client has funded more than 2% of its assets, then you are subject to the self-dealing rules. And when you're subject to the self-dealing rules, first of all, you can't play solitaire, even if you want to play solitaire. But secondly, under the self-dealing rules, you wouldn't be able to co-own things with your private foundation. Now, one shortcut to get around this is if the client doesn't mind setting up a school or a clinic that qualifies as a hospital or a medical research organization or a church or other house of worship, then you're not subject to the self-dealing rules. But let's say that the client wants to provide scholarships to their alma mater and wants to provide for needy families, or wants to provide for animals, or wants to provide for the environment. Well, wouldn't it be nice if they could take that C corporation that they don't really like anyway and donate 99% of it to a private foundation and get a big fat income tax deduction, never pay income tax on the dividends from that C corporation, and use the dividends from that C corporation to save the world or help the world? How could they do that? Well, the answer is they could transfer non-voting stock in the C corporation to the private foundation. But then you have two issues. One is the self-dealing rules if they're going to control the company. And the second issue would be the excess business holding rules. Well, you get around the excess business holding rules simply by only giving non-voting stock. But what do you do with the voting stock? And that's where Code Section 4946A1G comes in. And you may say, gee, Alan, what does that mean? Well, Section 4946A1G says that a trust, which is held no more than 35% for a disqualified person or parties related to a disqualified person, which means is held at least 65% by others, for the benefit of others, which could include charities, will not be considered a disqualified person, even if a disqualified person is the trustee of that trust. So if this is a $10 million company, the client puts $1 million worth of voting stock into this trust, and the trust eventually is expected to pay $350,000 to the client, or $340,000 to be safe, to the client's family, and the remaining amount, $660,000, can be paid to perhaps ex-employees of the client's companies who are no longer working for the companies, to provide them with retirement and educational benefits. Whereas for the benefit of a cemetery organization, there's many alternatives. Now, you cannot have this trust split interest trust. So it cannot be a charitable leave annuity trust. It can't be a charitable remainder trust. It has to meet some other requirements. But now the client can control it, and the client can, in a fiduciary duty, donate non-voting stock in their C corporation to the private operating foundation. Now, you could do this with a partnership, but then the private operating foundation is going to have unrelated business taxable income issues. So if the not-for-profit, if the for-profit entity is taxed as a partnership, put the 99% partnership interest in a C corporation if that doesn't trigger gain, and then transfer that to the private operating foundation. With 1 minute left, I'll also tell you that this complex trust on the top right, which qualifies here, could buy assets from the private foundation or loan money to the private foundation, which the client can't do. So the client comes to you and says, I'd like to loan $1 million, I'd like to borrow $1 million from the private foundation, or I'd like to buy this property from the private foundation for $1 million, where I'm sorry, you can't. But you could set up a trust, 34% for your descendants, 66% for others, put $1 million in that trust, and then have that trust buy the property. And then maybe that trust would receive ordinary income, and maybe that trust could donate the income to the private operating foundation, and you could get your 642C deduction. So our time is up. The puppet is ready to say goodbye. I want to thank you for attending this presentation and pretending to enjoy it. There are more coming. We just don't know what they all are yet. Thank you. That was terrible. Well, I don't think it was that bad. No, it was bad. It was really bad. Okay, well, we'll try to do better. We welcome your questions, comments, and suggestions. Thank you again, and I hope the rest of your day and weekend will be every bit as good as it can be. Thank you.